Hello and welcome to the Manifested E-Learning platform. Today we're going to introduce the paper Auditing and Assurance. This paper has 16 topics and the learning outcomes are as follows. A candidate who passes this paper should be able to, number one, demonstrate an understanding of the regulatory framework governing the external audit of financial statements. Number two, demonstrate an understanding of the international standards on auditing where appropriate and the International Code of Ethics for Professional Accountants, including international independent standards. Number three, implement the process of planning an audit, prepare audit programs, and effectively conduct an audit. Number four, undertake audit risk assessments, including group accounts. Number five, apply the risk-based audit approach to audit of limited companies. And lastly, prepare non-complex audit reports for audit engagements. That is what is required of you. By the end of this training, you should be able to carry out the functions that I've outlined under the learning outcomes. As I said earlier, there are 16 chapters. The first one is the nature and purpose of an audit. Number two, assurance and non-assurance engagements. Number three, legal and professional framework. Number four, planning and risk assessment. Number five, audit risk assessment. Number six, audit planning. Number seven, audit documentation. Number eight, internal control systems and internal audit function. Number nine, internal audit function. Number 10, overview of forensic accounting, errors, frauds, and regularities. Number 11, errors, frauds, and regularities. Number 12, audit evidence. 13, audit in the public sector. 14, audit reports. 15, auditing in a computerized system. And lastly, contemporary and emerging issues in audit. We will be covering each and every topic. In today's topic, we will begin with the nature and objectives of an audit. Nature and objectives of an audit. But first of all, what is an audit? What is the meaning of auditing? Now, candidates, auditing is the systematic and independent examination of an organization's financial records, statements, and operations to ascertain their accuracy, fairness, and compliance with applicable laws, regulations, and standards. That's the meaning of auditing. It is a systematic examination or an independent examination of an organization's financial records. To audit is to examine. To audit is to examine. So auditing is the systematic and independent examination of an organization's financial records, statements, and operations. And the purpose for carrying out an audit is to ascertain their accuracy. That is the accuracy of the financial records, the accuracy of the financial statements. To ascertain their accuracy, to ascertain the fairness, and to ascertain whether the financial statements were prepared in compliance with applicable laws, regulations, and standards. In accounting, accountants are required to prepare financial statements based on certain standards we are referring to as accounting standards, like the International Financial Reporting Standards, like the International Accounting Standards. There are companies that are also bound by specific industry regulations and standards, where, for example, the Capital Markets Authority may require companies to prepare or to provide certain records. So when an auditor carries out his or her examination, One reason is to find out, to ascertain whether the company complied with the applicable laws, regulations, and standards. And it involves an objective evaluation of the information presented by managers to the stakeholders, such as the investors, the shareholders, the creditors, the regulators, and so on. Objectivity is key. It involves an objective evaluation of the information that is presented, because candidates in the corporate world, financial statements are prepared by the management. It is the role or the duty, responsibility of the management to prepare financial statements, which are then presented to the management. I mean, presented to the owners or the shareholders, or presented to the regulators, or presented to investors. Do you understand? Preparation of financial statements is the responsibility of the management. So the auditor comes in to examine, to evaluate whether the statements presented to the management are accurate, fair, and that they comply with applicable laws and regulations. And I know most of you, by now you have studied the agency theory, particularly in relation to management and ownership of corporations. There is that agency problem that arises due to the separation of ownership and control in modern corporations. We have the shareholders, who are the principals, who own the company, who delegate the day-to-day management to the managers, who are the agents. And that separation of ownership and management creates potential conflict of interest, as agents may prioritize, the managers may prioritize their own interests over those of the shareholders. It is as a result of that agency problem that auditing plays a crucial role in mitigating the agency problem in various ways. Okay? So, candidates, we have the owners, who delegate their day-to-day obligations to the managers. These provide capital. They may not be available to manage the company, so they delegate that responsibility to the managers. So these are the principals, and managers are agents. The moment you have this separation, where those who are managing are not the owners, and the owners are not the ones managing, there arises a problem which you are calling the agency problem. And that problem arises where managers prioritize their own interests over the interests of the owners. That's why these owners consult or engage or hire auditors. Auditors play a crucial role in resolving the agency problem. because now these auditors, you've said, are independent individuals or parties. It's an independent party, independent of management, independent of the management. They do not report to the management. So the manager's role is to make available financial statements which are audited. So the auditor ascertains the accuracy, fairness, and the auditor also checks if the financial statements have been prepared in compliance with the applicable laws, regulations, and standards. Then reports to the owners in form of a report. The auditors, upon examination of the financial statements and records and information, they submit a report to the owners in which they give an opinion on the fairness and accuracy of the financial statements. So do you understand? So auditing plays a crucial role in mitigating the agency problem. In various ways. One way is through independent verification. Independent verification. Independent is a key word. Independent verification. Auditors act as independent third parties, because this is the first party, second party. Auditors are the third party. In this game, the auditor is an independent third party. The auditor is not the owner and does not manage. He comes in as an independent party. Okay? He's independent of or free from any undue influence from the management, because he's appointed by the owners. So he's free of any influence by the management. He's hired by the owners. His remuneration is determined by the owners. So that makes him an independent third party who independently verifies that the financial statements as presented by management are accurate, fair, and they comply with applicable laws and regulations. You understand? Their objectivity ensures that the financial information is reliable and free from material misstatements, thereby reducing the risk of agents who are the managers manipulating information for their personal gain. Do you understand? Remember, we talked about agency problem, which may arise because of the separation of ownership and management. So the very fact that the managers know that there will be a third party who will come to examine their financial statements, that mitigates the risk of them manipulating the financial statements for their own personal gain. So that is one way in which auditing plays a crucial role in mitigating the agency problem. The other way is through enhancing transparency and accountability. Enhances transparency and accountability. Independent auditing enhances transparency and accountability. Audits promote transparency by providing a comprehensive and unbiased view of the company's financial performance and position. And that enables the shareholders to make informed decisions and hold the management accountable. So the management prepares the records, which are verified by the auditors, who then make an opinion and submit a report to the owners, who can then rely on this independent objective report to hold the management accountable, so that if there is any misdeeds by the management as reported by the auditors, then the owners can hold the managers accountable. They can fire the managers, they can warn the managers. So it helps in enhancing transparency and accountability. Audits also may deter fraud and misconduct. Deterrence of fraud and misconduct. Deterrence of fraud and misconduct. The knowledge that financial statements will be scrutinized by independent auditors acts as a deterrent to fraudulent activities by the managers. And some of you who are in the accounting profession, the day you hear that auditors are visiting and maybe your records are not in order, that can make you fear for what may transpire. Okay, that's what we are talking about, deference of fraud and misconduct. And it's human nature, candidates. If you know that someone is watching you, then you may behave so that your misdeeds are not known. It's the same concept. The fact that the auditors are to carry out independent review of the financial statements as prepared by the managers, that very fact is a deterrence of, it deters fraud and misconduct. You understand? And that fosters a culture of ethical behavior and responsible financial reporting within organizations. It is a deterrent. It deters fraud and misconduct. Protecting stakeholder interests. An audit can help protect stakeholder interests. Auditing safeguards the interests of various stakeholders, including investors, creditors, including employees, including the general public. Auditing ensures that the company's financial statements are accurate and are reliable, which is crucial for decision making and risk assessment. Before a bank advances a loan to the company, the bank may need to have audited financial statements so that the bank can determine whether the company qualifies to be advanced loans, for example. So these various stakeholders are required to make decisions as they interact with the company. And these stakeholders need information that is verified. And it is through auditing that such information is verified, and that protects stakeholder interests. Auditing safeguards the interests of various stakeholders. Do you understand? It also strengthens corporate governance. All right? Corporate governance. Auditing strengthens corporate governance. Auditing is an integral part of a robust corporate governance framework. It complements other mechanisms such as internal controls, risk management, board oversight, in order to ensure that the company operates in a transparent and in an accountable manner. So these are 5 ways through which auditing can help mitigate the agency problem between the owners, that may arise between owners and managers in the corporate world. Auditing, candidates, I repeat, plays a pivotal role in addressing the agency problem by promoting transparency and accountability, by promoting ethical behavior, by deterring fraud and misconduct, by protecting stakeholder interests, and it acts as a watchdog, ensuring that the interests of shareholders are protected and that the company's financial statements and reporting is accurate and reliable. And by mitigating the agency problem, auditing contributes to the overall stability. It contributes to the overall sustainability of the corporate world. Because without auditing, the owners may not get reliable information, which may lead to corporate failure. But by the very fact that managers know that there is a watchdog, then they are likely to engage in ethical conduct, without which the auditors will report to the owners who may fire them. So you see, auditing, being a watchdog, contributes to the sustainability and the stability of the corporate world. And companies that have independent auditors who are objective are likely to experience long-term success. And that marks the end of today's lesson, in which we have defined auditing, in which we have outlined the origin or the concept or the reason behind auditing, which we have said that arises as a result of the agency problem that arise between the separation of ownership and control of a company. We've identified 5 ways through which auditing contributes, or through which the auditing mitigates the agency problem. In our next lesson, we are going to discuss the nature and objective of auditing. But here is your today's assignment. Define the term auditing. Number 2, outline 5 ways in which auditing may mitigate the challenges posed by the agency problem. Bye-bye.
So dear learner, welcome again to our continuing lessons in human resource management. In our last lesson, we had looked at the separation strategy, and we had initially looked at the forms of employee separation. We introduced and looked at redundancies. We also looked at dismissals, stroke discharge, and today we are going to look at another area, which is retirement. Our lesson today is on retirement. So this area of retirement within a working environment may be contained in the terms and conditions of service that an employee signed with the employer. And retirement in the working context, dear learner, refers to an employee coming to the end of their working life, and this is how it's looked at. So retirement is the time when an employee comes to the end of his or her working life in an organization. So the concept of retirement, this is the time when an employee comes to the end of his or her working life in an organization. Now, what this means, an organization may have, for example, indicated that at the age of 55 years, an employee may opt maybe for retirement. At the age of 60 years, this becomes now the mandatory retirement age. So an employee may opt at the age of 50, or the employee may have to retire at the age of 60 years. So that then becomes the retirement age. There are basically two types of retirement. Types of retirement. Types of retirement. Now, one, you have what you call voluntary retirement. One, voluntary retirement, and two, mandatory retirement. Mandatory retirement. We have just given an example. An employee may opt to retire, and when it comes to mandatory retirement, this one is not optional. Once an employee reaches that particular age, that particular employee has to retire. So in terms of the administration of the retirement separation process, dear learner, the guidance will be based on organizational policy, and also agreements of employment. Agreements of employment. When employees enter into a contract of employment, it is indicated within the contract of employment how separation may occur based on the aspect of retirement. So again, as it were, different levels, different ages of retirement exist. Some organizations may even have, say, 70 years, like for example, those associated like with the judiciary. Judicial officers may be able at a particular category retire at the age of 70. There are also organizations where it is also 74 years. So this again depends on the terms and conditions and organizational policy or the legal framework within that particular context. So this is the aspect of retirement within organizational setting, and you need to familiarize yourself because you may be involved in the process of carrying out these particular policy decisions, or as an employee, you may reach a point where you want to make certain decisions regarding your retirement. Then there is the aspect of resignation. So resignation is normally initiated from the part of the employee. This is where an employee may provide, for example, give a notice to the employer that I would want to terminate my services by a given period of time. So resignation is the termination of an employment contract of service by an employee. So resignation Resignation is the process of termination of a contract of employment by an employee. So this is a situation where the same way an employer can be able to terminate the services of an employee, this is now an employee on the side also having the option to terminate a contract of employment. So this is initiated by the employee, and the employee may put in a resignation, and that resignation may require a particular procedure, for example, to be followed in relation to that arrangement. Then you also have what you call types of resignations. Types of resignations. So types of resignations, you may have what is referred to as voluntary resignation. Voluntary resignation. And two, involuntary resignation. So what is meant by voluntary resignation, Lana, is that voluntary resignation is where the employee themselves, on their own volition, tender a resignation or provide a notice to resign. When it comes to involuntary resignation, this is where the employee may be encouraged by the employer to put in a resignation, and in most cases, this is done on a mutual basis. And it's normally to assist the employee access particular benefits, because if the employee is dismissed, the employee may lose certain benefits. So the mutual agreement between the employee and the employer, an employee may be requested to put in a resignation, which is referred to as an involuntary resignation by the employee, so that it could end the employment contract on a mutual basis. Now, what could be some of the reasons why employees may resign? Reasons for employee resignation. So what could be some of the reasons? You could be asking yourself, dear learner, what could be some of the reasons why an employee could tender a resignation? So one of them could be better employment prospects. An employee could resign from a given job to be able to access a better job elsewhere. Two, unfavorable working conditions. The prevailing conditions in a given organization may not be favorable to a given employee, and that could lead to an employee tendering a resignation for the sake of moving on. And then you have three, training and development. So an employee could resign from an organization to go maybe and further their education, or to access a training program that the employer may not be able to be interested in, and the employee has no other alternative. So they may want to be able to leave an organization. There are also what you call personal reasons. An employee may argue that for their own personal reasons that may be confidential, they may want to resign from a given working environment. And then number 5, hostile supervision. So where the supervision within an organization is hostile to workers, that could make employees leave that kind of a work environment because of the hostility in relation to that. Then 6, lack of promotion, promotion opportunities. Then number 7, climatical conditions. And employees, for example, an employee may not be able to operate effectively in a given climatical condition or environment, and that could also lead to an employee to move. Also, the aspect of lack of promotion opportunities. An employee has been in a given position maybe for, say, 20 years, for instance. So that kind of a worker may have a feeling they may retire without accessing any promotional opportunity. Then number 8, old technology. So if an employee, especially younger employees, may want to be associated with, say, new technology, for instance, and an organization is using obsolete technology, then that could make employees to leave so that they can go and work in organizations that are having modern technology in terms of working and so on. So this could be some of the reasons. There is also the element of poaching by other employers. There is also the issue of poor performance, poor organizational performance. So an organization, for example, that has been performing very well on the Nairobi Stock Exchange, its, for example, value could start going down, and workers have a feeling that maybe this kind of an organization is collapsing. So workers will want to leave when the organization is still maybe not performing very well, so that they could go to other places. And then there is the element of poaching, maybe for talent by other organizations. So that again could be one of the reasons that can make workers move or resign from a given work environment. So in our lesson today, Lana, we have looked at separation, forms of employee separation, and we were looking at retirement, where we have indicated that retirement is the time when an employee comes to the end of his or her working life in an organization. It may be 55 years, it may be 60 years, it may be 70, maybe 74 years. Types of retirement, we have indicated that you have 1, voluntary retirement, then 2, mandatory retirement. And when it comes to resignation, we have indicated that resignation is the process of termination of a contract of employment which is initiated by an employee. And there are various types of resignations, and we have indicated that there is what you call voluntary resignation, number 1, and number 2, involuntary resignation. And then we have gone further and looked at some of the reasons why employees may resign from organizations, and we have indicated that 1, employees may resign to be able to access better employment prospects. Number 2, unfavorable working conditions in an organization. And number 3, training and development opportunities elsewhere. Number 4, personal reasons. Number 5, hostile supervision. Number 6, lack of promotion opportunities. Number 7, unfavorable climatical conditions. Number 8, old or obsolete technology. Number 9, poaching of employees by other employers, maybe for talent. And number 10, poor organizational performance of a given entity. Those could be some of the 10 reasons that may make employees resign from organizations. So dear learner, before we end our lesson today, you have an assignment that you need to do to be able to enhance assimilation of this knowledge. And your assignment for today's lesson is discuss the reasons that may make employees to resign from an organization. So, dear learner, this is your assignment. Discuss the reasons that may make employees to resign from an organization. So, we have looked at our lesson today, which has been forms of employee separation. We have looked at retirement, types of retirement, resignation, and reasons why employees may resign from working for a given organization. And we have also looked at an assignment. So thank you very much for being attentive in our lesson today. Learner, welcome to our lesson today, Human Resource Management subject on the Manifested Publishers Learning Platform. And today we are looking at performance management, and we are going to look at an interesting area, which is techniques of appraising performance. We will look at the two categories of techniques that can be used to appraise performance, categorized in terms of the traditional methods and also the modern methods. Then we'll see examples within each of those particular categories. So here, learner, techniques or methods of appraising performance can be categorized into two. So you have one, you have traditional methods. Number one, traditional methods. And then you have two, modern methods. So basically, learner, the difference between the two methods is in relation to the approach that is taken in relation to the method of appraising performance. So within the traditional methods, there are also approaches that are used, and also within the modern methods, there are also approaches which are used in appraising performance. So we can have a look at the traditional methods. Methods of appraising performance. Traditional methods of appraising performance. So under the traditional methods of appraising performance, there is a feedback mechanism method. Method. So under this method, the supervisors will give the employees feedback. Employees give feedback to the supervisors, and the process is a feedback-based method, so that those who are being appraised, those who are appraising, are able to get the information in a loop method to ensure that the feedback is given regarding the targets or regarding the aspects that have been used for the performance process. And in that then is one of the traditional methods of appraising performance, which can be used in a given organization. Then there is the performance ranking method. Performance ranking method. So in the performance ranking method, the way the word suggests, there will be a rank where the performance of a given employee is ranked, the performance of another employee is also ranked, and then based on the ranking scale that is used, a score is obtained, then that score is the one that is used in appraising the performance and informing decision making. Then there is what is referred to as critical incident method. Critical incident method. Critical incident method. So through this learner, dear learner, through this technique or this approach, what the supervisor does, the supervisor will keep some kind of a record in terms of incidences that occur within the working environment. If an employee, for instance, is not able to meet a target in the month of January, that is noted. If an employee damages a machine or equipment in the month of February, that is noted. So those incidences that are critical in relation to the work environment are taken note of. Then when it comes to appraising the performance of that particular employee, these critical incidents methods are put into perspective, and the performance of that employee is evaluated as to whether it is good or it is satisfactory, whether it is very good, or maybe if it's excellent. Then based on that, it is possible to be able to evaluate the performance of a worker during a given period of time. Then you have the rating scale method. The rating scale method. Rating scales. Method. So through the rating scales, scales are put in place in relation to maybe say competency or the attitudes of a given worker, and these scales could, for example, be given maybe a scale of maybe 1 to 5, where maybe 1 for a particular attitude, for example, is the lowest, 5 is the highest. Then several scales that are relevant to a given position or a given job are taken into consideration, and then that total that an employee receives over a period of time could be taken as if it, let's say maybe the scales, the maximum is 5, and there are say 5 scales, so the maximum points will be 25 in relation to that particular evaluation. So the highest is 25, the lowest is 5. So depending on where an employee falls, then that performance is evaluated in relation to the rating scales that are used in terms of that particular setting. So these ones are examples of performance appraisal methods that may be used in a given setting. And we have indicated that you can have traditional methods, you can also have modern methods of evaluating performance. So we can also have a look at modern methods. Of appraising performance. Modern methods of appraising performance. So there are various options that an organization may make use of, and the modern methods of appraising performance tend to improve on the traditional methods of appraising performance, and there are several of them. One of the modern methods of appraising performance is what is referred to as management by objectives. Management by objectives. Management by objectives. So the propounder or the founder of this particular management by objective method was Peter Drucker. So Peter Drucker opined that if managers and workers, or supervisors and workers, set particular objectives within the organizational context, then those objectives can be used to be able to evaluate the performance during a given period of time. So if an organization wants to increase its market share, then it could agree between the managers and the workers in that particular section, for example, that is the objective to be achieved. Then within the performance of the jobs of those employees, those objectives are broken down. So management by objectives. So objectives can be set. They are focused at the organizational level, but they are broken into the jobs that these particular employees do. Then that becomes a method that can be used to be able to be applied in relation to appraisal of the performance of a given employee. Then you also have what you call the 360-degree feedback. 360 degree 360 degree feedback method of appraising performance. So Lana, this sometimes is also called multi-stage feedback method. Now, what happens to the proponents of this particular approach? The proponents of this particular approach argue that you should have various approaches through which you can receive feedback. For example, you can receive feedback from supervisors about the performance of a given employee. You can also receive from the peers or colleagues of that particular worker. You can also receive feedback from the employee, You may also go and receive feedback from the customers, for example. So once you look at the supervisor's input, the peers, you look at the colleagues that are working with that particular employee, you look at the customers or clients and the employee themselves regarding their performance and regarding in terms of how they do their work, then that feedback can form a basis on which appraisal of performance can be undertaken within a given organization and certain decisions made for the purposes of evaluating the performance of a given employee and so on. Then next you have what you're calling a balanced scorecard. A balanced scorecard method. A balanced scorecard method of appraising performance. So, dear learner, this was propounded by Norton. Norton were the propounders of this particular Kaplan and Norton. Kaplan and Norton. So Kaplan and Norton argue that when it comes to an organizational setting, you may want to look at different perspectives, and these perspectives not necessarily have to be financial perspectives. So they brought in the element of 4 perspectives, where they looked at the financial perspective, they looked at the customer perspective, they looked at the learning and growth perspective, and when you look at the internal, you look at the learning perspective, and then you look at the customer and financial. So these perspectives are able to give you a view of the entire organization in relation to the performance of this particular employee. So the most important and crucial aspect, this balanced card appraisal of performance looks at financial and non-financial, and non-financial perspectives of appraisal So that you are looking at, say, financial, you are looking at the customer perspective, you are also looking at internal perspective, you are also looking at learning and innovation perspective. So these four perspectives will give you a clear picture of how an employee has performed. So the most critical contribution that Kaplan and Norton brought into appraising of performance is that their balanced scorecard introduced non-financial perspectives in terms of evaluating performance of a given organization. So, dear learner, these are different methods of appraising performance, and an organization may use a combination. You may find that for a particular organization, they may find that the balanced scorecard can be used effectively, maybe in the area of, say, marketing staff or marketing employees. They may use, for example, a 360-degree method when it comes to, say, administrative employees. They may use employees. They may use management by objective, maybe, for example, for departmental heads, because departmental heads are directly dealing with issues that relate to the objectives of the organization, and it is easier for that particular organization to be able to break down their performance in relation to objectives tied to the organizational objectives. So in today's lesson, learner, we have looked at techniques of appraising performance, and we have indicated that there are various techniques that are available at the disposal of a given organization. And these methods of appraising performance can be divided into two, where you have traditional methods of appraising performance. You also have modern methods of appraising performance. And we have gone ahead and looked at the traditional methods of appraising performance and indicated that some of the methods, traditional methods of appraising performance, include, number one, a feedback mechanism method. And through this method, the supervisors and the employees provide a two-way loop so that feedback is provided and desired behavior or conduct is evaluated and so on. Then number two, performance ranking method, where the performance of a given employee is put on a scale and ranked, and that is the performance ranking method. Then number three, critical incident method, where the supervisor takes note of critical incident methods that are associated with the job, and those ones are taken into consideration when appraising the performance of that kind of an employee. Then the rating scales, where we have said the attitude or certain attributes can be put on a rating scale of, let's say, 5 to 1, where 1 is the lowest, 5 is the highest, and then critical attributes are picked for a given job. Then that is evaluated for that particular employee. Then we have gone ahead, learner, and looked at modern methods of appraising performance, where we have said they may include management by objectives, which was propounded by Peter Drucker. 360, that's the first one. Then second one, 360-degree feedback method of appraising performance. It is also referred to as a multi-stage feedback method. Here, supervisors, peers or colleagues, employees themselves, customers can also be used to provide information for appraising the performance of a given employee. Then you also have the balanced scorecard method of appraising performance that was propounded by Kaplan and Norton. And in that particular balanced scorecard perspective of appraising performance, there are four aspects. Financial perspective, you have four aspects, four perspectives: financial perspective, internal perspective, customer perspective, learning and innovation perspective. And what is critical to note, the balanced scorecard method of appraising performance was a pioneer method of appraising performance that included both the financial and non-financial perspectives of appraising performance. So Lana, we have come to the conclusion of our lesson today. And before we conclude, I need to leave you with an assignment. And your assignment for the lesson today is assess the techniques of appraising performance that may be utilized in an organization. So Lana, this is your assignment, and your assignment is assess the techniques of appraising performance that may be utilized in an organization. So we have come to the end of our lesson today, which was techniques of appraising performance in the performance management lesson under the human resource management subject under the manifested learning platform. Thank you very much for being active. Dear learner, I'm delighted to welcome you to our continuing lectures under the manifested publishers learning platform. And we are continuing with our lectures in human resource management. And today we are going to look at one of the areas that is also very interesting. And we are in the area of performance management. And we want to focus and have a look at characteristics of performance management. You may want also to refer to them as prerequisites. What are some of the prerequisites of performance prerequisites or characteristics for effective performance management in an organization? But before that, learner, it is important to note that performance management is a complex concept that encompasses different dimensions of the organization. It encompasses different dimensions of the organization. Performance management is a complex concept that encompasses different dimensions of the organization and people, different dimensions of the organization and people. So we are saying that when you look at performance management, you are looking at an organization, you are looking at performance indicators or key performance indicators, you are looking at financial aspects, you are looking at non-financial aspects, you are looking at expectations of individuals, you are also looking at what is happening in the external environment and impacting on a given organization. So given that this is the idea or the concept of performance management, then it becomes necessary that we need to be aware of some of the characteristics or prerequisites of performance management. So what are some of these characteristics or prerequisites prerequisites, characteristics or prerequisites of effective performance management. Effective performance management. What should organizations do, or what should the work environments do to ensure that performance management is effective in those particular organizations? So there are several prerequisites which we want to look at, and one of them is clarity of organizational goals. So one, clarity of organizational goals. Clarity of organizational goals. So Lana, because ultimately the performance that we are looking at, even if you are looking at the performance of the individual, you are looking at the objectives of the individual. Ultimately, the objectives of the organization are larger, and they are the bigger ones. And sometimes even individual objectives have to be sacrificed for the expense of the larger organizational objectives. So one of the areas or prerequisites of effective performance management is that goals have to be clear within a given organization. And then the aspect of evaluation. And when we talk about evaluation or appraisal, evaluation has to be done gradually and on a continuing basis to ensure that at any one given time, organizations are able to evaluate the performance of workers, evaluate the performance of the organization vis-a-vis key performance indicators. Then thirdly, cooperation but not coercion. Cooperation but not cooperation but not coercion. So what we mean here is that performance management as a process is realized with the input of employees and supervisors. So supervisors should be able to seek cooperation from employees and not coercion, so that there is a win-win consensus situation. Then self-managed teams. So when it comes to teamwork within organizations, it is imperative that organizations set up teams and they encourage self-management, so that those teams can work with minimum or no supervision, so that organizations can achieve the targets they have set to achieve. Then there is the element of leadership development. So in this context, supervisors should be able to develop the potential of leaders within their departments, within their sections, so that leaders who take over as captains of organizations can be able to grow from within the organization. So leadership development is another characteristic or prerequisite to ensure that there is effective performance management in a given organization. Then there is supposed to be what is referred to as in an organization a system of feedback. System of feedback. So in any system, a communication loop has to be created, so that the supervisor has to get information, the employee has to get information, there has to be feedback and clarifications made in the area of performance management or in the area of general performance. So we can again look at these much more closely and see these characteristics or prerequisites of effective performance management. How can they be entrenched in a given working environment to ensure that an organization achieves its performance management targets. So we have said, Lana, that for effective performance management in an organization, clarity of organizational goals is important. So in this context, goal setting and goals and objectives are expected to be smart. They are expected to be simple, they are expected to be measurable, they are expected to be applicable or appropriate, they are expected to be realistic and time-bound. So once this is done and there is an agreement between supervisor and employee, then they say in strategy that what gets measured gets done. So that is possible that if both parties are clear in terms of what is supposed to be achieved and what is supposed to be strived for, then the performance management process can be effective. Then when it comes to evaluation, this evaluation is supposed to be continuous. So the evaluation approach that is supposed to be adopted in an organization or appraisal approach, you don't have to wait from January to December to do an evaluation. An evaluation can be done after every, say, 2 weeks, after every 1 month. Evaluation is done and appropriate intervention measures taken. So evaluation is supposed to be continuous, and an organization is supposed to use appropriate tools to be able to carry out that particular evaluation process, to be able to provide intervention at the opportune time. Then when it comes to cooperation but not coercion, organizations that are progressive normally strive for consensus. So here is where you may not agree on everything, but you may want to convince workers or convince managers and supervisors in a work environment that even if there is a conflicting view, but we agree by consensus to be able to do this particular, take particular action and so on. So this one helps also in building synergy and a sense of involvement and engagement is enhanced. So when employees are engaged, are involved in the process and so on, they cooperate and so on, even if challenges come, the organization can be able to surmount those particular challenges in relation to the approach that is taken, and this one can also enhance what is called the goodwill of all stakeholders. So that again can be able to contribute towards effective performance management processes in a given organization. So the aspect of self-managed teams. So these self-managed teams are self-driven. So you may have what you call team targets. So these team targets are built around a group. This one could be maybe a section. This could be a department. This could also be a branch. So once you have self-managed teams which are self-regulating, then it is also possible you can get what you call high performance work design, where there is an element of autonomy and individuals are innovative, and these self-managed teams can be able to contribute towards team targets, and they can also be given what are called team incentives. Then the element of leadership and leadership development. Here, supervisors, managers are expected to identify talent and build the next level of leaders. So basically, Organizations are supposed to develop other levels of leaders and so on. So when supervisors involve employees, they identify talent, they build these particular employees, they give them an element of skills development, capacity building, exposure, then that is one way also of growing the performance management process, because it enhances the understanding of organizational objectives. Then when it comes to the system of feedback, an organization is expected to build what is called a foolproof. Foolproof. An organization is supposed to build what is called a foolproof feedback system. A foolproof, or solid feedback system. Feedback system. So this system is meant to ensure that whenever communication is given, so here you are supposed to have what you call communication loops, so that there is a two-way or a multiple approach, two-way system, such that if management is communicating to workers, workers should be able to get that particular communication, and workers should also be able to communicate to management, so that you have got the communication forward, communication backwards, clarifications are made, so that employees, if they have got any views, can reach management, management can also communicate. So if there is a foolproof or solid feedback system and clear communication loops, then that one can be one of the strategies that can be taken, or one of the characteristics of effective performance management system in an organization. So Lana, we have looked at the characteristics or the prerequisites of effective performance management, and we have noted that the performance management process is complex. It has many parties, it has stakeholders, it has management, it has workers. So management has to ensure that it puts in place measures to be able to encourage an effective performance management system. And we have indicated that performance management is a complex concept that encompasses different dimensions of the organization and the people in that organization, plus other stakeholders. And we have noted that some of the characteristics or prerequisites for effective performance management may include, number one, a clarity of organizational goals in terms of goal setting, formulation of strategies, organizations, business plans, and so on. So there must be a clear or clarity of organizational goals, because they are the ones which then provide the direction. Then we have indicated that, number two, there should be a continuous process of evaluation of what is taking place in a given organization. And number three, we have indicated that there has to be cooperation but not coercion when it comes to management-worker relationship, where an organization should strive for consensus in order to tap into synergy. And number four, we have indicated that there should be self-managed teams, and here teams should be encouraged to be self-driven with team targets to work together in terms of creating high-performance work design. Number five, leadership development, where supervisors and the organization in terms of its management should be able to at least spot talent and build an organization and build the next level of managers to empower them. Then number six, system of feedback. An organization should be able to develop a system of feedback where the organization is able to have a solid or a foolproof feedback process with communication loops to open up barriers that could be there in terms of communication, to ensure that the organization is operating from the same page. So these ones are some of the characteristics which could be noted, or prerequisites where effective performance management is practiced. So dear learner, before we finish our lesson, I want to leave you with an assignment, and your assignment for today's lesson, which was characteristics of performance management, discuss your assignment is discuss the characteristics of effective performance management. Characteristics of effective performance management. So dear learner, this is your assignment for today's lesson, which was characteristics of performance management in performance management lesson of human resource management subject under the manifested publishers platform. So thank you very much for being attentive in the lesson.
How are you over there? My name is Patrick Kamau Kamure. You are lecturer in taxation. Welcome to today's lesson of public finance and taxation, where we continue looking at the taxation of the business income, where if I can give you a little of recap of what we did, is that we said that there are three businesses that we need to see how they are taxed. One of them is the partnership, is the sole proprietorship. The other one is the partnership, and the third one is the limited company. In our previous lesson, we did the taxation of the sole proprietorship. So for today, we want to go to the next business, which is the taxation of the partnership. So partnership is where we have two or more people who come together to do business together, and they don't register their business as a company. Because of that, we normally say that partnership do not have a separate legal entity from the owners, and that will mean that when you are taxing the partnership, you tax the partners themselves, not the partnership itself, because it is not separate from the partners. They are partners, and the business, they are one and the same thing. So now we want to see how do we normally tax the partnership business. First of all, I want to write over there the introduction or definition of the partnership as I've illustrated. So we have partnership is a business owned by two or more people which is not registered as a company, and so does not have a separate legal entity. That is the definition of the partnership. But our objective or goal is to know how we usually tax the partnership business. So these are the items that you need to consider when you are taxing the partnership business. So areas to consider, or items to consider: while taxing partnership business. Number one, determination of taxable income. Determination of taxable income, and say this is done using either or A, gross profit method. Or number 2, or B, net profit method. What we are saying is that when you are determining the taxable income of the partnership, just like other business, and as we introduced earlier on when you are introducing to the taxation of the business today, any business, when you're determining the taxable income, you either use the gross profit method or net profit method. So the same criteria apply to the taxation of the partnership. You either use the gross profit method or net profit method to get the taxable income. We have Roman 2. Another items that you need to consider when you are determining taxable income of the partnership or taxing the partnership is the following expenses. Are not allowable in partnership. I.e., salary to the partner, to partners, interest on capital, interests on capital from partners, to the partners, commission and bonuses to partners, drawings by partners, and any private expense of the partners. That is the second thing that you need to know, that those expenses, when they are incurred by the partnership, they are considered to be non-allowable expenses. Salaries to the partners, interest on capital, bonuses, the commission, the drawings. In short, we are saying any expense relating to the partner, like private expenses of the partner, we don't allow them when you're determining the taxable income. The third one that you need to consider, the following incomes. Are non-taxable incomes in partnership, i.e., what are those incomes that are not taxable? Interest on drawings, profit on goods sold to partners, and any other income. Any other income from partners. That's another thing, that when you're determining the taxable income of the partnership, if there's any income that the partnership receives from the partners, we treat it as non-taxable. This you hear like interest on drawings, like when the partner withdraw anything from the partnership, like goods, the cash, they charge interest. That is an income to the partnership, but it is usually not taxable. Another thing is like sometimes they can have a provision, or the partners can have a provision that if a person wants to buy goods from the business, can buy and they are going to be charged a profit like any other customer. So that profit is not taxable in the partnership, and any other income that the partnership may get from the partners. The fourth one is the income distribution schedule. Distribution schedule. What does that mean? Once taxable income of partnership is determined it is distributed to partners using income distribution schedule where they bear individual tax burden. They are taxed individually at graduated scale rates in the same way as employment income. After the distribution. The gross tax. The gross tax, once determined, then set-offs such as personal relief, insurance relief, and withholding tax on investment incomes are deducted. Income distribution schedule has the following format. So what we are saying is that about the income distribution schedule, once the taxable income of the partnership is determined, either using the gross profit or the net profit, we tax the income on the partners themselves, and we tax them at graduated scale rates. Graduated scale rates is the same as the employment income, the way we taxed the sole proprietorship, where once you distribute to the partners, because the partners are the one who bear the tax burden, you tax them individually. It is partner A, how much is the taxable income, tax individually at graduated scale rates. Partner B, how much is the taxable income, tax them individually. And then once you get the gross tax of each partner, you less the set-off. Set-off, we said that they reduce the actual tax they are supposed to pay, and they are like personal relief, the withholding tax on investment income, and insurance relief if they have life insurance cover, education insurance cover, or NHIF. Now, I want to show you how the distribution is done through the income distribution schedule or allocation schedule. So it has this format: income distribution stroke allocation schedule. We start by distributing the taxable operating income, and then we list the partners. Partner A, we are assuming partners are A, B, and then we have a column for the totals. Shillings, shillings, shillings. So the taxable operating income you would have determined using either gross profit method or net profit method. You come distribute it this way. The first one is usually the salary. So salary to partners. If partners have the salaries, if this one had a salary, you put there this one and the total. The next one is interest on capital. Interests on capital. So interest on capital for this partner, for this one, and this, if there is any. Then commission or bonus. You put on this, this, and this. After that, those three are the one that you usually post. If there is commission or bonus, interest on capital, salaries to the partners. Then you less interest on drawings. Interest on drawings. So interest on drawings here, you less. If anybody withdrew the goods and they were charged interest there. Now, after you have distributed those one, the taxable operating income you'd have determined, you minus what you have distributed, minus this, minus this, minus this, but this one you add. Then whatever remains you share according to the profit sharing ratio. We call it profit share. Shared according to profit sharing ratio. So you come, how much is this? This total. And then after that, get the total taxable operating income. Total taxable operating incomes means we take the salary, the interest on capital, if there is commission or bonus, less interest on drawings, profit share, you get the total here. You do the same for this, you do the same for that. Now, you have just distributed the operating income. Then you add taxable investment income. Taxable investment incomes shared according to profit sharing ratio. Sharing ratio. So if you have something like rent, non-qualifying dividend, non-qualifying interest, royalty, all those, remember, withholding tax is not final. You come and share here according to the profit sharing ratio. This one, total. And then now from there, you can get total taxable income. Total taxable incomes, which will take the operating income plus investment to get the total. Operating plus investment, operating plus investment there. And now, if you are asked about now taxing, getting the tax payable by partners, you will tax this one A individually on this using the graduated scales, the way we tax a sole proprietor's income. The same case, this one, A, B, tax on this one to get the tax they are supposed to pay. So that is what you need to know when you are taxing the partnership business. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Hi there, my name is Patrick Kamau. You are a lecturer in public finance and taxation. Welcome to today's lesson. Today we continue from where we stopped last time. Remember, the topic we are looking at the moment is called the taxation of the business income. And we said that there are three businesses that we need to look at how they are usually taxed: the sole proprietorship, partnership, and the limited company. So far, we have looked at the sole proprietorship. Last lesson, we did look at we started looking at the partnership, whereby after looking at how partnership is usually taxed, we went ahead and we used the net profit method to get the taxable income of the partnership. So today we continue with the same lesson, but we look at another question where we used a different approach to answer the same question, a different question using now the gross profit method. Welcome to today's lesson. So we are going to start by reading the question. After reading the question, then I'm going to help you solve the question. So here is the question. This is what the question says. Karimu and Shika commenced trading in partnership as Kashi on January 2019. They share profits and losses in the ratio of 2:1 for Karimu Shika respectively. The partners were to receive monthly salaries of 18,000 and 22,000 for Karimu Shika respectively. The partnership did not maintain complete set of accounting records. The following summary of the bank statement for that year has been presented to you. So we have the receipts consisting of capital introduced, Karimu and Shika, cash sales, receipts from debtors, sale of a van. We go to the payment side, equipment of office, rent for go down, salaries and wages, purchase of for resale, repair and maintenance, insurance, interest expense, motor vehicle expenses, sundry expenses, motor van purchased, tax penalty, electricity, medical expenses, balance carried forward. Additional information, number 1. The following payments were made in cash from the cash sales before banking. We have the motor vehicle expenses per annum, wages per annum, sundry expenses per annum, weekly drawings for Karimu and Shika. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118,000. As at that 1st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. Depreciation was to be provided on equipment at 10% on a straight line basis. As at that 1st December 2019, the amount owed to supplier was 780, while the amount owed by the customer amounted to 1420. An amount of 82,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad debt. This amount was excluded from the total amount owed by a customer as at that 1st December 2019. Salaries and wages include the salaries to the partners. The go-down had been occupied since 1st November 2019 at an annual rent of 450,000. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. The wear and tear allowance, and it's good to note that wear and tear allowance is the same as the capital allowance. So wear and tear capital allowance was agreed with the Revenue Authority to be 112,000 for the year ended at 1st December 2019. So number 11, closing inventory was valued at 620,000 on 31st December 2019. Assume that year of income had 52 weeks. Required, 1, adjusted partnership profit or loss for the year 2019, and number 2, distribution schedule of the profit or loss calculated in C1 above. So the first question is to get the taxable income, and we say that whenever you are told to get the taxable income of any business, you either use the gross profit approach or the net profit approach. Net profit approach, we said, is when you have been given net accounting profit or loss or income somewhere. If you haven't been given, you use the gross profit method. So this question, we are not given the net profit or loss or income. So automatically we use the gross profit method. Now gross profit method, we said, we usually start with the sales. We less the cost of sales. Cost of sales, we take the opening stock plus purchases, less closing stock minus any item that reduce the stock. And then we get the cost of sales. We less from the sales, we get gross profit. And the reason why we call it gross profit, we said. And then you add other taxable operating income, and then you less the allowable expenses. So, but we said before you start, always confirm. Do you have the sales? Do you have the total purchases? If you don't have, or you haven't been given, then in that case you have to determine them first. So in this question, we take note that we're starting with the sales. We are given only one, the cash sales. But the cash sales does not represent the total sales. We have to look for the credit sales. We add to the cash, we get the total. So now, we are not given the sales, so we have to look for it. The other one is the purchases. Have we been given the purchases? Yes. In the payment, in the statement of bank statement, there is a purchase for resale, but that is a cash purchase. Now, how about the credit? So in this case, we have to determine the credit purchase so that we can add to that cash, we get the total purchases. So this is what we said you normally do. to get the total sales, you do it this way. You say total sales is equals to credit sales plus cash sales. We said for the cash sales you'll be given, it is there, like we have seen it's already there. The issue is about the credit sales, where you have to determine it. Now, the best way to approach the question, we said, leave a space like 2 lines, where now you'll be able to open the debtors or receivable account to determine the credit sales. So we'll come here and have the debtors stock receivable. You start with balance brought down here, that's what we said, for the debtors. And then jump 4 or 5 lines here, where you'll be posting those items that affect the debtors. And then balance at the end here for the debtors. And then totals will be here. Same case on the purchases, we say total purchases is as a result of credit purchase plus cash purchases. For the credit purchase, we jump a space of 2 or 1 line, and then we have the creditors or payables account, where we will be able to get the credit purchase. Then for the creditors, you start with balance brought down here for the creditors, and then jump 4 or 5 lines, then have the balance carried down for the same creditors. And then you'll be able to post everything and the totals there. Once you have done that, now go through the whole question. If you come across some cash sales here, something affecting the debtors here, cash purchase here, anything affecting the creditors here. So we start. From the first paragraph, the only figures that we have are 18,022, which were monthly salaries to the partner. So those do not affect, so we ignore. We go to the receipt. Capital, introduced, that's not. Cash sales, yes, here. So we post it here, 12,700,000. And then receipts from debtors. Receipts from debtors, we said it reduces the debtors. Here, receipts, which we have 5,200,000. Then sale of motor van, that doesn't affect. We go to the payment side. Equipment for the office, that does not affect. Rent for the go down doesn't. Salaries and wages, no. Purchase for resale, yes. Here, that's a cash purchase, of which case we have 9,900,000. The other one is the repair and maintenance doesn't affect. Insurance, interest, motor vehicle, sundry expense. Motor vehicle purchase, that's a fixed asset, not goods. Remember, what we are looking for are for the goods. Tax penalties, electricity, medical expense, balance carried forward, those do not. Then we go to the additional information number 1. The following payments were made in cash from cash sales before banking, meaning what went to the bank, as we can see, the bank statement was this. But before that figure was posted, not really this one, but the one in the bank statement, we had 12,700, this one. But before they banked the 12,700, they had paid some expenses, meaning our cash sales was more than what was banked. So to get the how much it was, we need to add the one that was sold on the one that was sold on cash and then used to pay the expenses. Which one? Motor vehicle expense. So the key thing there was from cash sales, were paid from the cash sales. Motor vehicle expense per annum, that we had 138. 162,000. The other one is wages, 162, plus sundry expenses per annum, 35. Then weekly drawings by Karimu and Shika. So weekly drawings for the whole year, it has to be for the 52 weeks. So 52 weeks times now weekly for the total, which is 7,200 plus 6,400, and that ends there. From there we go to number 2. During the year, discount received from the supplier amounted to 132,500. Discount received reduces the creditors, so we'll have it here. Discount received, which we had 132,500. The other one, while discount allowed to customers amounted to 118,000. Discount allowed, which reduces the debtors. Discount allowed, which we have 118,000. I want to bring this one a little bit up here, but I haven't changed anything. It's just this, and so we had said the balance carried down for the creditors. We leave it there. So we continue. After that, we go to the point number 3. As at 31st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. That doesn't affect. Depreciation was to be provided on equipment at 10% straight line. No. As at 31st December 2019, the amount owed to supplier was 780. Now this at the end of the year, what the supplier are owing is 780,000. And then while the amount owed by customer 1420. What is owed by the customer is 1420 at the end there. We continue. An amount of 82,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad. This amount was excluded in the total amount owed by the customer as at 31st December 2019. So that's a bad debt written off. Bad debt written off reduces the debtors written off, which we have 82,000. 82,000. The other one is number 7. Salaries and wages include salaries to the partners. That doesn't affect. Number 8, go down had been occupied since 1st November 2019 at an annual rent of that. Doesn't affect. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. Doesn't affect. The wear and tear allowance was agreed with the Revenue Authority to be 112,000 for the year 2019. Doesn't affect. Closing inventory was valued at 620 on that 1st December 2019. Doesn't affect. So we are done. So from there we do the computation. So we are going to add the totals on this side and compare to the total on this side. Actually, we have seen the balance brew down is 0 and also balance brew down here because we started the business at the beginning of the current year. So there was no balances from last year. So it's all about the total on this side will be now the credit sales here. Credit sales. So we add them 5,200,000 plus 118,000 plus 82,000 plus 1420, which gives us 6820,000. And this one 6820 should be the totals. 6820 because we now have written the balancing figure. So then this one we transfer it here 6820,000, which we should be able to add now the cash. So we'll start by taking 7,200 plus 6,400 times 52. So it will be 7,200 plus 6,400 times 52 weeks because that was per week. That becomes 707,200 plus 35,000 plus 162,000 plus 138,000 plus 700,000. Then now we add this one plus 6820,000. 68,20,000, giving us 20,562,200. That is the total. We come here, we add this plus this. This is 0, so that will be the credit purchases. So this plus this, 132,500 plus 780,000. So that will be 912,500, which will be here 912,500. 912,500. We transfer that one here, 912,500. And then now we add the cash purchase. So plus 9,900, which give us 10,812,500. There. With that one now we can prepare the statement of determining the taxable income. So we'll come here, the name of the partnership is Kashi Enterprise Partnership. We get the taxable income for the year ended 31st of December 2019. So we start with the sales, which we had determined 20,562,500. Then we less cost of sales. Cost of sales, which we take the opening stock. But here you'll note that we were not given the opening stock because we started the business at the start of this year. So there were no opening stock from last year. So 0 plus the purchases. Purchases is what we have determined here. 10,812,500. Then we minus the closing stock. Closing stock is the one given in point number 11, 620,000. So minus 620,000. And then we also minus any item that could have reduced the stock during the year. Damaged, withdrawn stock, stolen, of which case the whole of this question, we didn't have any stock that was stolen, damaged, or withdrawn by the partners. There was none. Let me confirm properly. There wasn't any. The drawings that we are given in additional information, number 1 was cash drawings, not goods. So in this case, we cross to get the cost of sales. Cost of sales, which will be the 10,812,500, you minus 620,000, and that gives us 10,192,500. And then we can be able to get the gross profit. Gross profit will be, we minus that from 20,562,500. And that gives us 10,370,000. Then we said this, after getting gross profit, and the reason why we call it gross profit method is to add other taxable operating income. Other taxable operating incomes. Other taxable operating incomes. Of which case we said you jump a space of like 3 lines and then you less. I want to bring this one here, 1,000. So you less allowable expense after jumping around 3 lines. Allowable expenses. So what we do now, we go through the whole question. If we come across a taxable operating income, an allowable expense, we post here. We start from the top. The first paragraph was about the salaries to the partner. We said anything to the partner we don't allow. It's an expense yet, but not allowable, so we cannot post. We go to the summary of the bank statement. On the receipt side, capital is not an income or an expense. Cash sales, we used it to get the sales. Receipts from debtors, we used it to get the sales. Sales from the van, we said income from selling fixed assets, we don't tax, so we cannot post here. We go to the payment. Equipment. Equipment is a fixed asset, which we should claim capital allowance at the rate of 10%. But we won't do that. Why? If you look at additional information number 10, we are told the wear and tear allowance, which we said is the same as capital allowance, was agreed with the revenue authority to be 112,000. So that's the one that we use. Anywhere we require to compute capital allowance, we use that. So we can even post it now. The capital allowance, also called WTA or wear and tear allowance for the year. It was agreed to be 112,000. From there, we go back to where we found that in the bank statement. After equipment, rent for go down. That's an allowable expense, rent expense. But we have an additional information to that rent. If something has an additional information, check it out. In additional information number 8, the go down has been occupied since 1st November 2019 at an annual rent of 450. So annual is per year. And now it was occupied from 1st November. Those are 2 months. So forget about the one that you are given. Use the one that you can get for this particular year. So in this case, we are going to take 2/12 times the 450 because it was only occupied for 2 months to the end of the year in this particular year. So this is going to be 2/12 times 450. That will be 75,000. That is the one that we allow. Any other, we forget. Then we go back. After the rent for the go down, salaries and wages. That is allowable. But we have to check whether it is mentioned somewhere else. Salaries and wages. Yes, it had been mentioned in additional information number 7. The salaries and wages include the salaries paid to the partners. Salaries. And here they have made it very clear that it is salaries and wages. Another place that we have wages now mentioned is number 1. The following payment made through the cash from the banking. So we have the wages. So what do? We'll come here and have the salaries and wages. So we open a bracket. Remember, we want to know the allowable salaries and wages for this year. 890,000. And then now we have to add the one that was paid through the cash. This was through the bank. The cash was 162. And then number 7, it includes the one paid to the partners. So we have to remove because we said anything to the partners we don't allow. To the partners was how much? In the first paragraph is where we were told the monthly salaries to the partner was 18 and 22,000. Monthly, underline monthly. So meaning to get the whole year, we have to take minus 12 times 18,000 plus 22,000. So that we can get, and since it is not mentioned somewhere else, we do the computation. So we take first of all the 18,000 plus 22,000, and then you multiply by 12 months because it was monthly. We get for 80,000. Then we remove them from this. So we take 890 plus 162 minus 480. That gives us 572. That's the one that we should be allowing there. After that, we go back to where we found the salaries and wages. After salaries and wages in the bank statement, purchases for resale, that we used to get the purchases up there. Repair and maintenance, that is another allowable expense. Repair and maintenance. So we check if it is mentioned somewhere else. There isn't. So we just pick the figure as it is, 860,000. After that, we go back. After the repair and maintenance, there is insurance. Insurance is also a lovable expense. So we have insurance. Is it mentioned somewhere else? Yes. Additional information number 3. As at 31st December 2019, electricity and insurance prepaid. So this was prepaid, and it's at the end of the year. We said prepaid at the end of the year is for next year, not for this. Anything that is not for this year, we minus. So we are going to take the insurance of 62.5, and then we minus the prepayment, which we have 12,800. That will give us how much? This will be 62,500. We minus 12,800. That gives us 49,700. After that, we go back to where we found the insurance. After the insurance, there is interest expense. Interest, we said, is allowable. So interest expense. But it is mentioned somewhere else. In additional information number 9, included in the interest expense is the interest on partner's capital contribution at the rate of 5%. Included in interest. Anything to the partner we don't allow. So we will take this interest, which is 12,000, and then we minus the one that was paid to the partners, which was 5% of the capital. The capital is in the bank statement, where we have for the two partners 3,500 plus we have the 2,500, that is 2,500,000. That. So we add the capitals, which are 3,500 plus 2,500 times 5%, which give us 300,000. And we minus from 612, that give us 312,000. That's the one that is allowable, the one paid to the partners. Then we go back after the salary, after the interest, after the interest. Motor vehicle expense. Motor vehicle expense is allowable. And we say that is not the cost of motor vehicle, it's the vehicle, expense incurred to run the motor vehicle. Fuel, repair. So in this case, that is allowable, not a fixed asset. Motor vehicle expenses. Where we are told the motor vehicle expense is 186,500. After that, we have sundry expense. Maybe there is something that I should have confirmed. In additional information number 1, there is more motor vehicle expense. The one that was paid in cash, 138. We forgot about that, so we should add it. So it will be 186,500 plus the one that was paid cash, which we have 138,000. 138,000. We check if it is mentioned somewhere else, but the motor vehicle is not mentioned anywhere else. So what does that mean? Then that means that we do the computation. 186,500 plus 138,000, which we get that 245,000. That 245,100. Then we go back after the motor vehicle expense. We have sundry expense. Sundry expense is an allowable expense, so we continue. Sundry expenses. And this one again, it is mentioned somewhere else in additional information number 1, the one that was paid through the cash. So we'll have 218,000, and then we add the one that was paid through cash, which we have 35,000, which we have 218 plus 35,000, which give us 253,000. Then we go back after the sundry expenses. Motor van purchased. That's a fixed asset which we should claim capital allowance. But remember, we were already given the capital allowance, so we ignore. Tax penalties, we said any expense relating to tax we don't allow. Electricity expense, that is allowable. So electricity expense, but we check for the additional information. If you go to the additional information number 3, we had electricity prepaid, and we said prepaid is for next year. So that one we need to remove. We need to minus, because of what was paid this year of the electricity, 45,800, part of it is for next year, and so we should minus from here, where we have the 25,000. That gives us 2,800. Then we go back to where we found that. After the electricity, there is medical expense. Medical expense are allowable unless we are told it was relating to the partner, which we haven't been told. So medical expense. Medical expenses, 630,000. Then now we go to the additional information for any taxable, operating, or allowable expense. Additional information number 1. The following payments were made in cash from cashes. Motor vehicle expense we have considered. Wages we have. Sundry expense we did. Weekly drawings, those are not allowable expenses. Additional information number 2. Those are the figures for the balances of debtors and creditors at the end of the year. So they are not incomes or expenses. Number 3, we have already adjusted for them. Number 4, depreciation. Remember we said depreciation is not allowable. We claim capital allowance instead, which we have been given. Then number 5, as at 31st December 2019, the amount owed to supplier was 780, while the amount owed by customer was 1420,000. That we had said actually, there's additional information we jumped. We jumped number 2. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118. Discount received, that we know is a taxable operating income, so it should come here. Discount received, that is a taxable operating income. And we have the discount received of 132,500. And then we have the discount allowed. Discount allowed is an expense and it's allowable. Discount allowed. Discount allowed, which we have been given as 118,000. There. From there we continue. We were actually in point number 5. That's where we were saying that we had the balances at the beginning and also at the end. And then from there, number 6. An amount of 82,000 owed by Jamila Mamba, a customer proved irrecoverable, and it is to be written off as bad debt. This amount was excluded in the total amount owed by the customer as at 31st December 2019. That is a bad debt written off, which we said is allowable expense. So we'll have bad debt written off. Bad debt written off, which we have an amount of 82,000. After that, we go to number 7 now. Salaries and wages include the salaries paid to the partner. Now that we had adjusted in the salary here, if we had forgotten, now you should be able to adjust. Number 8, we had adjusted on the rent. Number 9, we had adjusted in the interest. Number 10, capital allowance we had posted. Closing inventory that we used to get the cost of sales here. There is nowhere else it's supposed to be used. Now that is the end. What remains, and this being a partnership, it should end here, is to get the net taxable operating income. So how do you get the net taxable operating income? It is the gross profit plus discount received minus these expenses. So we do the computation. So we start with the 10. There is 70,000 plus 132,500 minus 112,000 minus 75,000 minus 572,000 minus 860 minus 49,700 remember this was 749,700 minus 312 minus 324.5 minus 253 minus 2,800 minus 630 minus 118 minus 82,000. That give us 7,093,500. And that answers required one, where we are supposed to get the taxable profit of the partnership. With that one, we are supposed to go to the required number 2, where we do the income distribution. So the income distribution schedule, this is what we said or how it is supposed to look like. So income distribution schedule. We start by distributing the operating income. So we will start with taxable operating incomes, which is the one that we have determined here, 70,93,500. And then now we list the partners that we have, which we have Karimu, Shika, and now the totals. So we go through the question. Remember, we start by looking for the first 4 items that we said: the salary, interest on capital, commission or bonus, less interest on drawings. Those 4. So if you look at the first paragraph, we had the salary to the partner, salary, which we were told it was per month. So the first one was to get 18,000 times 12. The other one was to get 22,000 times 12. Because they were monthly amounts. So we have 18 times 12, which give us 216,000. So 216,000. The other one is 22,000 times 12, giving us 264,000. And now we have the total plus 216. 480,000. Then we go to the capital, to the cash bank statement. In the bank statement on the receipt, we had capital, which is not one of the item we are posting. You go to the payment side, there is none. You go to the additional information, number 1, drawings we said we ignore. Number 2, no. 3, no. 4, no. 5, no. 6, no. 7, we have posted. 8, no. 9, there is interest on capital. So interest on capital, which is supposed to be 5%. 5% of the capital. How much is the capital? In the bank statement, we have capital of 35. And also, the other one is 25 for each. So we start with 5% of 35, which gives us 175,000. The other one is 25 times 5%, giving us 125,000, and the total gives us 300,000. Then after that, point number 10, none, and 11, there is none. So the only remaining one is now the 5th one, profit share. How do you get the profit share? We said you take the taxable operating income we have, like in this case we have 70,93,500, And then you minus what has been shared already. We have shared the 480,000 and also shared the 300,000. So whatever remains you share according to the profit sharing ratio. And what was the profit sharing ratio? In the first paragraph, they were sharing 2 to 1. So the first one will get 2 out of 3. The other one 1 out of 3. So let's minus 70, 93, 500. We minus 480 and also we minus 300,000. 480,000 and 300,000 give us 6313. So 6313 500. Then the first one will get 2 over 3. That give us 4209. 4209 900. 1000, sorry. And the other one, we can take the 6313 500 minus what we have given this 63 13 500. That will give us 2104 500. And now we can get the total taxable operating income. Total taxable operating income. So for Karimu, it will be 216,000. We add 175,000. We add 4209, which we get 4,600,000. The other one will be 264,000. We add 125,000. And then we add 2104 500, which gives us 2493 500. And now the total, which will be 480,000 plus 300, and then we add 63 13,500. Which give us 1793 500, and which is the same as the operating income we had determined. Remember, if we had an investment income that is taxable for this question, after getting the operating income, we add taxable investment income, and we share and then get total. But the whole of this question didn't have an investment income. So meaning our question then should end here. So this one will give us now the total taxable income, which should end there. That is how we tax a partnership when you have not been given the net accounting profit. So for this question ends here. And now what is remaining is the taxation of the limited company, which we are going to look at in our next lesson. For now, we stop there until we meet in the next lesson. After this video, there is some assignments, questions that you can attempt. Kindly do attempt and then see if you can be able to do the way we have done it. Thank you very much.
Welcome to our another lesson on Introduction to Microsoft Excel. In our previous lesson, we started on working on how to work with basic formulas and functions in Excel. We looked at the formulas, among them addition, we looked at subtraction, we looked at division, we looked at multiplication, and we also looked at power in cells. So these are the formulas that we looked at last time that we had a lesson. Today, I want us to pick up from where we left and talk about more formulas about the same thing. We are going to talk about average. We are going also to talk about maximum. These are now statistical formulas. We are going to talk about minimum. How do you get the minimum value? We are going to talk about count. We are going to talk about mode. And we are also going to talk about some more formulas here. We are going to talk about standard deviation. Standard deviation, and maybe before I forget, there's also median that is to be done under the statistical formulas on basic formulas in Excel here. So this is what we want to cover, and it will be an extension of the work that you already have. Remember, we had this particular work that we used on our formulas last time. So this one is going to be an extension of what we already covered in our previous lesson. Let us begin by looking at average. So how do you get the average of some marks that you have with you? So average is operated the same way as what we did in the other formulas, like addition and also getting the product. So you can average in cell, you can also be able to average in range. Let us start by averaging in cell. Of course, every formula is preceded with an equal sign, then average, then you double click on average, that will appear there. Then you can click on the cell that you want, or you can type it manually. So in our case, let us click on, we want to get the average of Tom, so I'll click on 65. Then now we separate them with commas, so 65, then comma, 84, then comma, 70, then comma, 76, and if that is the end, you close the bracket, shift and the sign of closing the bracket on the keyboard. After that, you enter, and it will give you the average for Tom for all the units as 73.5. So this is the average, and you can be able to copy it down all the way to the last one, which is not Juliet. I believe there is something wrong there. On our product, in our previous class, I believe we might have included the wrong items. Let me just confirm what we did. Okay, that seems to be okay. It's all fine. So up to the last one, who is Tony. So we've gotten the average of Tom all the way to the average of Tony. I can undo, and I can start again by getting the average. Of course, equal sign, then average. You double click on the average. Then after double clicking on the average, you can type manually like B10. You can see it's highlighted, comma, C10, comma. But that is a long way. If you want to move faster, you just click on them. So 65, comma on the keyboard, 84, comma, 70, comma. Remember, if you want to jump one, you can always jump. Assuming that you never wanted the one for auditing, you can always jump and you click on the last one. So this one is now excluded in your average for that particular period, and you can see the average has reduced. So there's also another way, of course, average in range. So again, average, and you just select average in range. You select up to where you want, up to 76, then shift and you close the bracket. So that is average in range. Then you enter to get 73.5, from which you can be able to drag down your formula all the way to what you want, up to Tony, and you'll get all your averages for that particular student. You can also get average here, if you so wish, average and equal sign, or let us use now the other aspects. You can go to the formula place, AutoSum. If you see average, you click on average. There's average here, but this one will pick everything. You can see up to the next place where there's nothing. So this one majorly picks everything, but you can be able to highlight up to where you want, that is up to Tony, and it will give you everything that you want. If you enter, of course, the average is 66.60. You can undo, and again, in the formulas, you can use the insert function. You click on insert function. What do you want? You want average. Like that. So go, and you will see average highlighted here. Just click on it. Okay. Then you confirm whether B17 to B19 is what you want. B17 is B17 is just 15, subtraction, then B19 is just this one. So it's wrong. It means you can deduct or you can do away with it and select whatever you want to get the average of. So you just select, you can see it is moving all the way to Tony and your average is set. So the average is set. Once you have done the correct thing, you click on OK and you can see the answer is still 66.6. So whichever approach you use, of course the average is still going to be the same as in any other case. Average, you can see the answer is still 66.6. So you then drag across all the way to MA so that you can have your average up to MA. So that is the average of those particular items. Having done the average, the next thing is maximum. Now we want to do maximum. What is the maximum? What is the maximum? Maximum is the same as highest. Maximum is the same as highest. So we are looking for the highest value in our set of data under financial accounting. So equal sign, then max. So you look for the function of max. This one returns the largest value in a set of values and it ignores values and logical values and texts. Of course, this one is max. Then which one is the highest value? The highest value up to there. Then you close the bracket. This one gives you 88. So you can see in this set of data up to here, 88 is the highest value which has been returned by this. So if you copy across, it also gives you the other highest values in, like in this case is 84. In this case, you can see it's 70 is the highest value here. In this case, the highest value can clearly be seen to be 76, of course. So that is highest value using max. What about lowest value? How do you get the lowest value? Of course, when using the lowest value or getting the lowest value, you use mean. So we are going to use mean to be able to get the lowest value. And again, you highlight all the way to this one, and the lowest value there is that one. So the lowest value is 50. The formula is saying that it's 50. Let us see. The lowest value, indeed, 50. Here there is nothing, so it cannot count that. So 50 is the lowest value. There are two 50s, so it will just pick any. What about these other cases? You can drag across and get your lowest value. Again, here they are saying it's 50. Let us confirm. The lowest value is indeed 50 from this set of data. It's 50. What about 34 here? Is the lowest value 34? Indeed, yes. The lowest value is 34 from this set of data. Even here, of course, the lowest value is 24 from this set of data. It is 24. So that is the lowest. If you want to get the lowest value using minimum. Now we want to move to median. How do you get the middle value? Middle value, of course, we'll be using median. Equal sign, then we do median. So you double click on the median and you can be able to get the lowest value in that set of data, median. And that is median. Is it the median? Of course, when getting the median, Excel arranges from the lowest to the largest and then accesses the median value. So if you arrange these items from the lowest to the largest, the median value will be 65. So let us copy across and see which is the median value in the other cases. You can see the median value in these other cases here. So that is median, which helps us to get the middle value or the midpoint. So after the median value, we can also be able to get mode. Mode simply refers to the most occurring. So most occurring, that is mode. Most occurring. So let us see how do you get the most occurring in mode. So you can see mode. The function is available for this one returns the most frequent occurring or repetitive value in any array or range of data. So this one returns the most occurring. So again, we want to select here and get the most occurring in a set of data. And the most occurring that set of data is 50. Let us see if 50 is most occurring from here to here. Yes, 50 occurs twice. So 50 is the most occurring. If you copy across, you can see that it gives you 50 again here. And indeed, 50 is the most occurring, 50 and 50. But here, The answer is not available. That means there is no most occurring. So there is no most occurring here. There is no figure that is repeating itself in this set of data. So there is no most occurring. Even here, there is no figure that appears more than once. There is no most occurring in this set of data. So that's why the answer here is not available. And indeed, that is the that is the correct answer, not available. After that, you move to another formula. After most occurring, which is mod, we can be able to get the standard deviation. Standard deviation. Of course, standard deviation is equal sign then STDEV. That is the formula that you use for standard deviation. What is standard deviation? You can see it says estimates the standard deviation based on the sample. It ignores the logical values and text in the sample. So that we want to get the standard deviation of this set of data from here moving the way to this place. Then you close the bracket and this will give you a B10 to B15. If you enter, it returns the standard deviation as what you can see there. So that is the standard deviation. If you copy across, it gives you the other standard deviations from the other set of data there. So those are the other statistical formulas, basic of course for beginners, that you can be able to use in your work. You can be able to use to manage your work, either if you are a student or if you are working somewhere. These are the functions that are usually used when doing a lot of statistical and also mathematical tasks. There's an Excel file that is attached below the video description, which will use for your assignment. So make sure that you go through it and redo almost everything that you've done, almost everything that we've gone through in this particular lesson. Thank you, and see you in our next lesson.
Hello learner, welcome to Manifested E-Learning Forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis, and what we'll be looking at today is technical analysis. And what specifically we look at under technical analysis, The specifics we will be looking at today include, we will start by looking at introduction, where I will be able to briefly explain the mechanics behind technical analysis. Then after the introduction, we'll look at the technical analysis principles. What principles guide technical analysis? Moving on, we will move on and look at the logic behind technical analysis. Then once we've looked at that, we will move ahead and look at the types of charts used in technical analysis. So what types of charts? Specifically, we will look at the following charts. We will start by looking at the point and figure chart. Point and figure chart there. Then we will look at the line chart there. We'll move ahead and look at the bar chart as well. And then we will finalize by looking at the Japanese candlesticks. Japanese candlesticks there. Then once we've looked at these types of charts, we'll move ahead and look at the door theory. Then we will be able to conclude this first lecture under technical analysis. Now, we start off by looking at the introduction to technical analysis. Why is the introduction important? The introduction will form the sound basis as to why we are conducting or understanding technical analysis. Why are we learning technical analysis? The introduction will try and create that or arouse that interest for you, the learner. Now, what I can be able to explain under the introduction goes like so. Technical analysis tries to cover up where fundamental analysis left off. Fundamental analysis looks at the identification of the intrinsic value of a security or an asset. That is what we have been doing by looking at the free cash flow method. We've been looking at the free cash flow method. We have mentioned about the dividend discount model. We've also looked at the price multiples. We've looked at the residual income. Using those models tries to identify the intrinsic value, the true and fair value of a security or an asset. So that once we've identified the intrinsic value, we are able to compare it with the current market price there, such that if we have the current market price, I can put that initials like that, is greater than the intrinsic value, then you are saying that the security or the asset is overvalued. So if the current market price is less than the intrinsic, it is the opposite of that. We are saying it is undervalued. Current market price is equals to the intrinsic, it is correctly valued, like that. That is what we have been doing by trying to look at those models that govern fundamental analysis. However, what fundamental analysis doesn't do is to try and explain the short-term price movements. What am I saying? These short-term price movements can be able to dictate whether there is going to be an uptrend or a downtrend, like that, which we will be able to try and demystify under technical analysis. What technical analysis does, technical analysis tries to step in and tries to identify cyclical patterns in the price movements of securities or assets there. We're trying to identify trends or trend movements. That is what technical analysis does, and it tries to fit in, especially more so in this short-term period, trying to identify which securities to purchase during the short term there. Probably you might have experienced this when going into an investment bank or a stock brokerage firm. You would want to purchase securities for the short term. Fundamental analysis cannot be able to assist the analyst to make a decision and trying to identify the securities to purchase. That is where now technical analysis comes in. And we will be shortly looking at the technical analysis principles so that we can be able to reinforce our understanding of this topic. So we can be able to mention something right here. You can say technical analysis tries to identify or assist the analyst stroke investor in decision making as to which securities or assets they should purchase. They should purchase or sell. Now I'll explain the concept, the mechanics behind fundamental analysis and why now technical analysis tries to fit in the shoes of fundamental analysis. Fundamental analysis only tries to identify an assets stroke securities intrinsic value. And we had explained in the topic under return concept what the intrinsic value is. I'll just recap on what we looked at. The intrinsic value is the true and fair value of an asset. What an analyst believes the value of the security should be based on the 4 valuation models we had looked at. The 4 valuation models include, I'll reiterate again, the free cash flow, the dividend discount model, the price multiples, and the residual income. We are trying to identify the intrinsic value, what the analyst or the investor believes the value of the asset should be. And you compare that with what the securities exchange provides as far as the pricing of the security is concerned. So if the current market price, which that one that is issued by the securities exchange, is if it's greater than the intrinsic value, the one that you've computed, then we are saying that the security is over or undervalued. So we are saying that the fundamental analysis only tries to identify an asset or security's intrinsic value and compare that value with the current market price. The decisions made under this approach is long-term in nature. It's long-term in nature. So when trying to identify using fundamental analysis, you're trying to identify after some period of time, you expect the share price to either be undervalued or overvalued there. Technical analysis, on the other hand, tries to identify securities stroke assets that should be purchased or sold. In the short term. Because you're saying that short-term price movements tend to also impact or create longer-term price movements over a period of time there. So that is the brief introduction that I have under the introduction to technical analysis. We are saying that technical analysis may play a very critical part, especially when trying to identify small short-term movements or movements within the short term, which is say within 1 to 2 years there. So now moving on from the introduction right here, we will be able to move on and look at the technical analysis principles. What principles guide technical analysis? So we say principles of technical analysis there. Now, having looked at and understood what the introduction or the mechanics behind fundamental analysis and technical analysis, the first principle states like so, that prices are determined. Number one, we can say prices are determined by forces of demand and supply, by forces of demand and supply. So we are saying that the demand for securities, if we have that demand curve here, so we have price and over here quantity like that, the forces of demand and supply. The demand curve is this one. I recall my economics, I remember the demand curve would go like that. And the supply curve would increase. You'd want to supply more to the market if the prices are increasing and like that. So that is the demand curve, demand versus supply curve there like that. And that is the equilibrium price. So we're saying that technical analysis is primarily driven by the forces of demand and supply. How many individuals are demanding the security or the asset versus how many individuals are supplying the asset to the market. So there must be something to do with an equilibrium price, the price that is acceptable to both the buyers and the sellers. Number two, the second principle states as follows, that the demand and supply forces, the demand and supply forces, talking about that demand and supply curve there, are influenced by fundamental factors. Forces are influenced by fundamental and psychological factors. Fundamental and psychological factors. Psychological factors. There. We are saying the fundamental factors uses the information that is provided in the financial statements for companies. So the fundamental factors, I've already explained what fundamental analysis only tries to do, tries to identify an asset's intrinsic value there. And psychological factors are the belief that any investor has for themselves, that I believe, for example, that KCB within the short period, within the short run, will be able to increase by say 50% or 70% like that. That is what you're saying is the individual factors that affect or that influence or support rather technical analysis. The third one, as follows, is that the fundamental factors can be psychological, can be quantified. We're talking about the fundamental factors can be quantified and the psychological factors cannot be quantified. So we say that the fundamental factors can be quantified, whereas the psychological factors cannot. So the fundamental factors, we're talking about trying to identify the intrinsic value, where we use numbers or figures. We can be able to at least identify that this, you're comparing the current market price versus the intrinsic value there. So at least that one can be quantified and like that, and a decision can be made using that. We are saying that psychological factors cannot be quantified because you cannot be able to identify individuals' perceptions about a particular stock, or neither can you also be able to quantify, say, the behavioral biases, because we are saying that behavioral biases can influence the market trends, either moving up or moving down like so. Then we can also say that the combined effect of the fundamental factors and the technical factors is reflected in security prices. So I can come on this side over here, say that the combined effect You can say that number 4, the combined effect of fundamental factors and technical factors what can we say? We can say that it is reflected in the price movements of securities or assets like that. That is the 4th principle that guides technical analysis. We can look at the 5th one there, and we say that past price movements assist in the prediction of future price movements or trends there. So those are the 5 principles that guide technical analysis. The first one, prices are determined by forces of demand and supply. The demand and supply forces are influenced by both fundamental and psychological factors. Then I've said that the fundamental factors can be quantified, whereas the psychological factors cannot be quantified. The 4th one here is the combined effect of both fundamental factors and technical factors is reflected in the price movements of securities or assets there. So these technical factors here and fundamental factors work in unison like that. Then we are saying that the past price movements assist in prediction of future price movements or trends. So we are saying the use of graphs and charts can be able to dictate or provide some bearing as to which direction the share price will move. Is it either going to be 1, 2, or 3 right there? So that is what we're saying. The analysis of past price movements like that can be able to dictate the future price movements in at least the short term. There. Now, having looked at the technical analysis principles that there, let's look at the logic behind the technical analysis there. Logic behind technical analysis there. Now, the best way to describe the logic behind technical analysis is to use a graph. A graph of price against time is the best example that we can be able to use to try and understand that concept, the concept of technical analysis. So we are saying this is the price there, and this is time there. So we have the old equilibrium price there. We have it going down like that, and then we have like that. So we can be able to say this is the old equilibrium price, because you are plotting a price against time like that. Then this is the new equilibrium price there. This part right here is when the information is being released into the market. So when the information has been released to the market, investors decide or that they're not going to take up the new security, or the company's mechanics or the specifics dictate that it should be able to go down there, and less demand for that security will reduce the price of that security. So we say here is release of new information. This is just a hypothetical example that I'm explaining. It could be also the other way around. So we could have like that, a graph up to there, then it goes like that, and then we can be able to put it something like that. So we say this is the old equilibrium price is much lower, then we can be able to have the new equilibrium price being much higher as compared to that. But this is just a simple explanation that can be able to guide the logic behind technical analysis. So that is what we have there. Now, having looked at the logic behind technical analysis there, we can be able to look at the types of charts and used under technical analysis. So we move on to look at the types of charts and used in technical analysis there. I hope this has actually provided some guidance. The logic behind technical analysis is simple. You just need to plot a graph of price against time, and you understand the impact of release of new information. Once information has been released to the market, then that creates or arouses some interest or disinterest. Meaning that in this case over here is a disinterest. This first graph that I do over here. So this is the old equilibrium price. The price was much higher over here. Then the release of new information, possibly negative information, reduced the amount of demand for that security or asset, and hence now the new equilibrium price is much lower than the old equilibrium price right there. However, in this dotted line which I've drawn moving up like that, this part over here indicates the old equilibrium price, which was much lower. The release of new information within that part over here aroused interest or aroused some form of demand for that security, so that you can be able to see over here that the new equilibrium price is much higher than this dotted line which began over here. So the logic behind technical analysis is just driven by forces of demand and supply. That is what I can be able to explain under the logic behind technical analysis. Now, moving on, let's look at the types of charts used in technical analysis right there. So I can come on this side here. Look at the types of charts. So types of charts used in technical analysis. Now the first type of chart that we are going to look at is point and figure chart, or rather let me start first of all by looking at the line chart. Yes, let me just start right here. I'll be able to explain all of them anyway. So the line chart. Now a line chart is a simple plot of price against time. Now this is how I can be able to demonstrate a line chart. Now we are saying here we have price, like that, price against time, like that. And as time goes by, the forces of demand and supply changes the price of the security or the asset. So you can begin there, it moves there like that, it moves down like that, moves as it moves up like that. So we are saying this is a line chart there, indicating this as time is moving at this part over here. You can see is different from this part, it's different from here, and so on and so forth, like that. That is what you're saying is a line chart. You just plot the prices against the time, or as time moves on, you can be able to plot the security and price pattern. So this is a line chart there. Now we look at what a bar chart is. A bar chart right there. So a bar chart is a chart that is drawn like so. You can draw it right here. That then we can say that this is just the plot of price still against time, like that. But now in this instance, what will happen is that we are going to plot now the starting price, the opening price, and the closing prices, like that. Here is the midpoint there. Then as we move on like that, we plot like that, a bar chart like that, and so on and so forth like that. So you can be able to clearly see that this is an uptrend, or the trend is moving in that direction. As well, in the line chart, you can also see this an uptrend moving in that direction. However, if it's moving down like this, say from over here, we can be able to decide maybe it goes down like that and moves down like that, moves down like that, and this is now a downtrend that is moving like that. That is what we can say is a bar chart. So I can indicate over here, just over here, number 2, bar chart. Like that. Now, having looked at those two, let's look at now the point and figure chart. The point and figure chart right there. Under the point and figure chart, a plot of only prices is provided, but now in a very different and unique way. The plot against price alone is the one that is used. So we are saying this is what we have like that, and then we don't have an x-axis there. We only have the y-axis here. So here you have prices of securities like that, and you are saying if you have a rising trend, you can be able to indicate that is for a specific time period, say within 1 hour, and the prices have actually increased up to that level there. So this is, say for example, 200, 201, 202, 205, 207, 210, and so on and so forth as we increase like that. However, after this 1 hour, you can be able to find that now the prices have begun to reduce. So you find that this is what happens. We can indicate the reduction using circles like that. And if there is an increase in prices as well, we can be able to continue and put X's like that. And if it's a downtrend, then we can be able to indicate like so, and so on and so forth like that. That is what you're saying is a point and figure chart. We can also plot a point and figure chart using the actual prices. So we are saying that over here, if you can be able to have, say, a parallel diagram right just besides this point and figure chart right here, and indicate now the prices over here. So we indicate, instead of having the x-axis indicating the prices like that, we put it now on the graph itself. So we have 200, 201, 202, 205, 201, 210, 210, and so on and so forth like that. Then you find over here now a reduction, 205, 202, 201, 200, 199, 198, 97, and so forth like that. Then we have now 201, 202, 205, 207, 209, and so on and so forth like that. So you can see there's a slight difference between this point and figure chart and this one, but you can be able to induce some kind of or infer some kind of decision over here. You can see this is the congestion area or the concentration area right above this part over here. That's what you're saying is the congestion area like that. Now, having looked at these three, we can say this is the third one over here, point and figure chart there. Then finally, we can look at the Japanese candlesticks over here. Why these are important is because technical analysts believe in the use of graphs and charts to try and identify price trends that can be able to assist them in making decisions as to which securities to purchase or assets to purchase. Number 4, we're talking about Japanese candlesticks. that, Japanese candlesticks. Now, what you need to understand under Japanese candlesticks is, first of all, the look of the candlestick itself. A candle looks somewhat like that. Here, before I